and thank you for joining us for the 2021 edition of the Financial Stability Conference of Banco de Portugal. My name is Katja Neugebauer. I'm a senior economist at the Financial Stability Department, which has organized this conference, and I'm your host for today. This year's edition of the conference focuses on macroprudential measures, regulatory policies, and government support measures that were put in place to address the impact of the pandemic. In addition to that, it will address the new challenges and risks for financial stability in the aftermath of the crisis. We will also cover topics on green and sustainable finance, as well as on big tech, fintech, and digital transformation in banking. We're very pleased that so many high-level speakers have accepted our invitation to discuss these important and very timely issues with us. To open the conference, I would now like to give the floor to Mário Centeno, Governor of Banco de Portugal.
Good morning. Thank you, Katja. I would like to start by thanking the Financial Stability Department for the organization of such a high-level conference. And of course, I am delighted to welcome all of you to Banco de Portugal's conference on financial stability. Despite being held virtually, I trust we will have a challenging and productive debate. I would also like to thank all speakers for accepting our challenge, and in particular Mark for acting as keynote speaker on this event. The COVID crisis and its effects on the financial stability system inevitably shade the ground of this year's conference on financial stability. In this context, it is important to understand the role of macroprudential measures, regulatory policies, and government support measures during the pandemic, and to recognize the challenges and risks for financial stability emerging in the aftermath of this crisis. Moreover, the crisis did not stop, on the contrary, reinforced previous challenges, namely the digitalization and climate change. Therefore, it is fundamental to understand how the crisis and its consequences interact with these ongoing issues from a financial stability perspective. Economic growth has picked up this year, helped by the gradual lifting of lockdown measures, vaccination, boosting both agents' confidence and immune system, and massive policy support. Euro area activity rebounded by more than anticipated in the second quarter of 2021. It is expected to continue to grow rapidly, exceeding its pre-crisis level in the fourth quarter of 2021. Moreover, the trajectory projected before the pandemic is expected to be reached by the end of 2023, and these are great news. If materialized, this never happened before. Overall, there will be no permanent economic loss from the crisis, even if with a different productive composition. This is a strong statement, I know, and it requires forthcoming policy decisions to be consistent with it. Remember that we will rest on higher debt, much higher. Employment is still to recover, with a lot of reallocation going on. We missed 4 million jobs in the euro area alone, and we have more 1.4 million unemployed today than before the crisis, so a lot still needs to be materialized. And of course, inequality, a consequence of all crises, can be harder to curb. I will conclude that there is no reason to be complacent with the good results, but we should definitely build upon them. Household expenditure remains the key driver of the recovery, supported by a rebound in real disposable income, favorable financing conditions, high confidence, and a relatively faster reduction of excess savings. Investment and public consumption are also providing a positive contribution, although more modest. A positive outlook does not mean that we are out of the woods, not yet. Several risks still loom. The possibility of new pandemic waves and longer supply bottlenecks are among these risks. During the pandemic, the banking sector proved its resilience. The global regulatory and supervisory reforms initiated after the financial crisis and the risk reduction of the 5 years prior to the crisis contributed to banks' preparedness. The banking sector was more capitalized and robust than in the previous financial crisis. Portuguese banks increased capital ratios through both equity and capital instruments issuance and retained earnings. The more robust capital position also supported a strong and continued reduction of NPLs, thus improving credit quality, and strengthening the balance sheet. As such, the banking sector was able to withstand the immediate pandemic shock. I also recall that the coordinated and prompt measures taken, unprecedented in terms of magnitude and scope, ensured that banks were part of the solution this time. At the current stage, the design of the policies should aim at supporting a sustainable and durable economic recovery of all sectors, while continuing to contribute to the mitigation of risks and vulnerabilities created by the pandemic shock. As the recovery progresses, the challenges arise, mainly those related to the need to promote the right incentives for banks to return to pre-crisis prudential standards. In this regard, banks should be prepared for the adoption of the final Basel III reforms and to replenishing buffers. A cautious approach also in provisioning should be followed in order to weather out problems in the medium to long term. The more favorable context that we are currently experiencing and the good news on the expected economic recovery cannot stop banks from their monitoring effort. It is important that credit institutions continue to pursue a prudent and conservative risk management and to conduct a detailed assessment of the viability of debtors, recognizing in a timely manner a possible change in a client's credit risk profile. In the current context, it is particularly important the setup of an effective legal and judicial framework governing corporate restructuring. In the case of firms considered non-viable, expediting corporate insolvency and liquidation proceedings takes on particular relevance. The adoption of a strategy to promote the solvency of firms that, albeit in financial difficulties, remain viable is equally important. In this regard, the Capitalization and Resilience Fund under the EU Recovery and Resilience Facility will definitely strengthen firms' capitalization rebounding economic activity. But let me move to a major challenge for the financial system and its implication for financial stability. It relates to the risk derived from the rapid technological change and digitalization of our economies. For their importance, they should be closely monitored. Financial regulation has to properly account for them. This digitalization trend has been supply-induced, largely by non-financial institutions whose core business is driven by technological innovation. Big techs and fintechs are indeed in the bone of the digital disruption. Big tech firms provide a one-stop shop for their customers, where shopping, financing, and payment can all be done through the same website, without having to resort to an additional intermediary. This convenience and reduction of complexity is an important factor in driving the adoption of new forms of financial services. Big techs are widely known and have the capacity to rapidly gain scale across different business areas, fostered by their large customer base. They have the potential to enter into the European financial services market in the future and rapidly become significant competitors. Their increased relevance as financial intermediaries justifies that they should be closely monitored. Fintechs tend to be more service providers for banks or are even funded or acquired by banks. But fintech credit exhibits considerable growth potential, especially in the area of SMEs financing, as small firms often struggle to procure traditional bank financing, representing another concern for the financial system. On a positive note, the COVID crisis pushed the banking system to move in the direction of digital transformation, not only in their relation with customers, but also in their internal procedures. We witnessed a re-acceleration of the process that was already developing at a fast pace before the pandemic, posing important challenges to banks. Banks might be incentivized to embrace technological change more quickly and become more efficient in their processes. This may increase the speed of the provision of financial services and reduce their costs. However, they might be induced to take on more credit risk in order to increase profitability and remain competitive. Providing a regulatory level playing field is absolutely crucial. At the moment, big techs fall outside the regulatory perimeter of direct supervision by financial authorities. The use of data about their clients collected through the platforms is a relevant resource that needs to be carefully regulated. Given the global scope of operation by fintechs and big techs, national authorities need to coordinate with respect to their supervision and regulation in different areas such as prudential supervision, data protection, and competition. This brings me to cyber risk. Cyber risk is gaining more importance given the interconnectedness of financial institutions and services, not only within a country, but also across borders. As many financial institutions may rely on the same providers for IT solutions, including cloud services, a cyber attack on a single large IT service provider might quickly take on a systemic nature. Therefore, cyber risk needs to be taken into account when thinking about prudential measures, including those of a macroprudential nature. However, thorough assessment of the systemic risk involved is needed beforehand, and the help of a stress test exercise or scenario analysis, taking into account the interconnectedness between financial institutions and their interlinkages with relevant non-financial firms. Regarding the financial stability challenges driven by crypto assets, I will focus on decentralized finance. DeFi, as it is called, is gaining momentum by offering new services to users because it removes intermediaries involved in financial transactions. It is often used to trade crypto assets without an intermediary and in credit platforms that match borrowers and lenders. Most of DeFi is built on the Ethereum blockchain and uses Ethereum-based tokens, including stablecoins. DeFi still bears considerable risks, in particular concerning its potential for money laundering due to sometimes insufficient knowledge of your client practices, coding or operational errors, and massive energy consumption of its blockchain activities. Once again, we should closely monitor developments in this arena. From the perspective of central banks, and in order to preserve public trust, in an increasingly digital society, the Eurosystem initiated the work on the possible issuance of the digital euro, aimed at complementing cash, not replacing it. By issuing a digital euro, the Eurosystem could provide a risk-free, costless, and trusted digital means of payment. It would support Europe's drive towards continued innovation and contribute to its strategic autonomy by providing a further alternative to external payment providers for fast and efficient payments. The digital euro could lead to the reinforcement of the European sovereignty in such a strategic field as payments, where smooth functioning is crucial for the conduction of monetary policy and the maintenance of financial stability. A final word on yet another big global challenge: climate change. Global warming is a negative externality with global consequences. Therefore, a coordinated global approach, in particular through the forthcoming COP26 achievements, will be the requirement for success. To limit global temperature rises to 1.5 degrees, the world needs to halve emissions over the next decade and reach carbon neutrality by the middle of this century. Now it is time to move from awareness and commitment to more effective action and actual delivery. Despite this, we cannot discard that climate change is effectively a source of financial risk, being it driven by transition or physical risks. In order to understand how climate-related risks threaten financial stability, a first important step is to quantify the exposure of financial institutions to climate risks. As for transition risks, this involves assessing the proportion of banks' balance sheet that is associated with firms in sectors of activity particularly sensitive to the transition to a low-carbon economy. Furthermore, granular information on banks' counterparties' location of assets is called for in the assessment of banks' exposures to physical risks. In this regard, central banks and supervisors have been working on the development of the adequate frameworks for markets to adjust, pursuing two avenues in particular. The first one, in the first avenue, we are upgrading the financial stability and prudential framework to incorporate climate-related financial risks. But we must avoid using the regulatory tools to promote green activities at the expense of higher risk-taking by banks. The second avenue means that we are contributing to the efforts of standard-setting bodies to develop comprehensive, useful, consistent, and comparable climate-related disclosures. And this issue on disclosures is quite important. Furthermore, we must lead market players' expectations in a way that is consistent with the transition pathways that political authorities are ultimately responsible to steer, as they have the most efficient tools in their power. Moreover, the distinctive features of climate-related risks means that they need to be considered and managed differently from other more traditional risks. Climate scenario analysis is therefore a key tool for forward-looking assessments of climate-related risks. In this regard, I recall that the Network for Greening the Financial System scenarios provide an important framework for analyzing the impact of physical and transition risks, allowing for a long time horizon under a common and consistent global reference framework. Against this background, remaining data gap and methodological challenges have to be addressed to evaluate climate-related risks comprehensively. And yet here, central banks have a great area and role to play in the future. Since our analytical work cannot wait for these developments to happen, we should be careful in drawing conclusions from analysis relying on non-harmonized data. In addition, climate litigation risks need to be considered. In particular, we need to consider the interplay between banks and insurers when assessing impacts of climate risks. From a financial stability perspective, it is essential to continue assessing both physical and transition risks and to understand their extent and transmission channels to ensure the right identification and mitigation of those risks resulting from climate change. Well, let me conclude. I have touched upon the main issues that will be discussed during the day. I hope that the ideas that I have shared with you might induce a fruitful debate or at least contribute to it. Now, I am very pleased to give the floor to Mr. Mark Carney. His work in the context of COP26 to embed climate into every finance decision and creating a more sustainable financial system to support the path to net zero is remarkable. I am eager to listen to his thoughts on the implications of climate change to financial stability. So I stop here, wishing you a very fruitful day, exchange of views, debate, and now let's move to Mark. Thank you very much to all of you.
Thank you, Governor. We will now proceed with the keynote speech on climate change and financial stability by Mark Carney, former Governor of the Bank of England and United Nations Special Envoy for Climate Action and Finance. Due to the time difference between Canada and Portugal, the speech has been recorded, but Mr. Carney will join us live this afternoon for the roundtable on green and sustainable finance. We can now start the video, please. Apologies for the short interruption. We will restart the video and hope to have the sound by then.
Thank you very much for having me, Governor Centeno, dear Mario. It's a great pleasure to be back, albeit virtually. I was thinking that when I was last in Portugal, it was under very happy circumstances at Sintra, a little more than 2 years ago. We didn't know what was coming. What was coming, though, or we felt there was a growing understanding of the importance of managing climate-related financial risks. But candidly, in retrospect, the efforts to align the financial system to net zero were just beginning to gather pace. And since then, we've had one global crisis, that of COVID, has struck, and another, that of climate, has intensified. And this renewed focus, as a consequence of the COVID crisis, on resilience and sustainability has helped move the concept from net zero from the fringes to the mainstream. And that public expectation is something we need to translate into climate action. The Glasgow COP26 summit, which will meet in a few weeks, begin in a few weeks, is about bringing companies, communities, and countries together to keep 1.5 degrees goal within reach. Now, there has been important progress. Since the United Kingdom assumed the COP presidency last year in partnership with Italy, the percentage of global emissions covered by net zero country targets has risen from less than a third to more than 3/4. And net zero is now an organizing principle that's cascaded down from the country level to the company, and thousands of our largest companies are setting net zero objectives and developing decarbonization plans to achieve them. Of course, this is not before time because the scale of what's required to achieve 1.5 degrees is enormous. Emissions must fall by 7% year on year over the course of this decade. And last year, the world met this high bar, but only because we shut down large swaths of the global economy and put millions of people out of work. And this, to me, underscores that we must invest and grow to get to net zero. The scale of that investment is enormous. In energy infrastructure, the scale of investment there needs to double to around euros 3.5 to 5 trillion euros per annum. Building a sustainable future will be capital intensive after a long period when there has been too little investment. It'll be job heavy when unemployment is still too high. It will be global when we're being pulled to the local, and it's what the world needs for its future, what our economies need right now. Now, in this respect, we need governments to lead. The more credible their commitments are to net zero, the more predictable their climate policies are, the more investors will pour money in anticipation, and the more a virtuous cycle between large-scale investment, faster decarbonization, and greater efficiency will operate. In many respects, this is an analog to effective monetary policy and understanding credibility and the market and agents reacting to that, a point Janet Yellen and I made in a paper last year. In terms of policy certainty, let me add voices of support for the EU's Fit for 55 package because it delivers the type of policy certainty that investors need. It has binding target, it has sector-specific policies, it has clean fuel mandates, and a fair mix of taxes and subsidies. But it's all within this context that private finance can play a decisive role, and I'll spend the balance of my time talking a bit about the agenda there. First, the objective. Our objective for COP26 is to create the information, the tools, and the markets to ensure that every financial decision takes climate change into account. It's a world where a company's contributions to climate change and climate solutions are fundamental determinants of its value and its risk profile. We're making progress in all aspects of their agenda. There are 24 core deliverables, and we're on target to meet them all. Don't worry, I won't go through all 24. I'll just signal some of the highlights. The first is around reporting. We all know what gets measured gets managed, and we need every major company to disclose how climate change affects its current and future business. Climate disclosure, TCFD-based disclosure, was a concept in Paris COP 6 years ago. Only 3 years ago, the final TCFD recommendations were delivered to G20 leaders. And today, virtually the entire financial sector demands this, and thousands of our major companies are responding. Now's the time to make this disclosure mandatory. Some, like the EU and the UK, are forging ahead with legislating for mandatory climate-related disclosures. And the EU's Sustainable Finance Disclosure Regime and Sustainability Reporting Directive puts in place the framework for that comprehensive reporting to provide investors with the information they need to make sustainable investment choices. It goes beyond climate, as you know, and it incorporates broader sustainability concerns and, importantly, double materiality. What we need now is a common baseline so that financial institutions everywhere around the world have comparable and consistent information. There's been encouraging progress. The G7 supported mandatory disclosure at Carbis Bay in June. The G20 in Venice welcomed mandatory TCFD-aligned disclosure at their meeting in Venice, as I said, as part of the FSBs. And we can look to lock in this approach at COP26 by establishing a new standard-setting body the IFRS's International Sustainability Standards Board, which will cover climate disclosure in over 140 countries. And the European Commission is working closely and collaboratively as part of this effort. Now, closer to central banks, better disclosure and a heightened sense of urgency are transforming climate risk management. A few years ago, a core group of central banks began developing new approaches to supervision and management of these risks. And this group, the NGFS, has grown rapidly from 8 original members to over 90 authorities in countries responsible for more than 80% of the world's emissions and all of the world's globally systemic and financial institutions. Central banks in countries responsible for more than half of the emissions are pursuing climate stress tests, including the ECB, the EBA, and it's very important that the Banco de Portugal is part of the NGFS. As a result of these initiatives, the financial sector will distinguish between those assets that will thrive in a decarbonizing world and those which will be stranded. After all, we can't have our banks and insurers fail if society succeeds. Now, given that climate change is an existential risk, it follows that those companies that are part of the solution will create enormous value. In order to do so, companies need to develop and implement net zero plans that include Scope 1, Scope 2, Scope 3 targets that are governed at the board level, that are tied to executive compensation, and which compensate for emissions during that transition. There should be clear near-term targets and commitment to the company's fair share of the 50% decarbonization on average that's required by 2030. Financial institutions play a critical role in backing credible net zero plans with capital and catalyzing those companies that are lagging. But those institutions will also be judged, and they also need to disclose how well they're aligned with the transition. And that was one reason why we launched at President Biden's April Climate Summit, the Glasgow Financial Alliance for Net Zero, or GFANZ, as the world's biggest banks, asset owners, asset managers, and insurers. It brings together more than 300 of the world's largest financial institutions, responsible for almost $90 trillion of assets, and anchored in the UN's Race to Zero. GFANZ is the gold standard for commitments to sustainability. By joining GFANZ, financial firms commit to manage investment, lending, and insurance underwriting to net zero by 2050. They set interim targets, they have that board accountability, and they have to report their progress annually. We're deepening and broadening GFANZ in the run-up to COP26. We're adding insurance underwriters, all the major financial services providers like the index providers such as MSCI, the major rating agencies, the major audit firms, and leading stock exchanges. And in effect, by Glasgow, all major financial firms should decide whether they'll be part of this solution to climate change. GFANZ starts with commitments, but its real purpose is climate action. So it's helping to work on some of the core plumbing, such as best practice net zero plans for companies and financial institutions, robust assessments of the alignment of financial institutions' portfolios relative to net zero pathways, and also creating new approaches to wind down stranded assets transparently and consistently with the net zero transition. And finally, there's a big focus on mobilizing capital at scale to finance the transitions in emerging and developing economies. And I'll finish with this. We know these economies need more than €1 trillion of additional investment annually by the end of this decade. We're currently far off the mark. Such financing for climate investment ranks in the tens of billions of dollars. We need programs that will scale up. And to drive that step change in financing capacity, we believe we should create country platforms to deliver that trillion of new annual flows. These will combine ambitious country NDCs and projects to help achieve them, GFANZ financing commitments for net zero aligned projects, and the expertise of MDBs to coordinate financing, provide blended financing, and encourage that investment. The final point is we need a new market, a new high-integrity market for carbon credits or carbon offsets. At present, this market is fragmented, it's of uneven quality, it's worth about €1 billion a year. This market could be worth somewhere between 100 to 150 billion euros a year and very importantly, facilitate major cross-border capital flows and provide significant co-benefits for biodiversity and other SDGs. My message is that the necessary conditions are coming into place. There's over 3,000 companies that have committed to set science-based targets. And these are the natural demand for these types of credits. The Winters Task Force organizations across the ecosystem. The governance body has just been put in place, including representatives from NGOs, market participants, major emerging economies. The next step is to move from blueprint to build. We will have the core carbon principles, the bedrock of this market, ready by the next summer, and expect exchange trading anchored in London and Singapore to come. Now, any country or company that is engaged with this essential market will be helping to maximize our very limited carbon budget. Now, speaking of limited budget, my time budget is exhausted, so I'll hand back the microphone with appreciation for this invitation and looking forward to the panel discussion. Thank you very much.
I think Mr. Carney has given us plenty of food for thought with his keynote, and we can all look forward to hearing more of his views and ideas on this topic during the roundtable this afternoon. We'll now start with the first session of today, Policy Responses During Black Swan Events, the effectiveness of macroprudential and regulatory policies, as well as of government measures affecting the financial sector. The chair for the session is Ana Cristina Leal, Director of the Financial Stability Department at Banco de Portugal. Before we start, let me give you some housekeeping rules. After the 3 presentations, there'll be a Q&A session. If you would like to ask a question, please virtually raise your hand by clicking on the respective symbol in the bottom right-hand corner. Please make sure that you have the list of participants activated on WebEx, otherwise you won't be able to see the symbol. When it's your turn, the session chair will let you know. I will then need to change your role in WebEx, and this will take a second or 2. And you'll get a notification on your screen. Then please turn on your video and unmute yourself, and please try to keep the questions short and to the point. Ana Cristina, the floor is now yours.